Welcome to the Six Figure Consulting webinar. Six Figure Consulting specialise in financial management and marketing. Today's webinar addresses the financial management aspects. The business management method, which is best for just about every business, whether it's large or small, is a process called management by objectives. Now, what is management by objectives? It starts with specifying the goals, what you're trying to achieve, and that means in the beginning you should map out a business plan, and in the business plan is where you first specify your goals. Now, after you've specified goals, you need to select the strategies that you're going to adopt to achieve those objectives, and that means setting out some tactics, the actual mechanics of how you're going to implement each strategy. Now, once you've implemented the business plan, that is, you've started your engine, you need to monitor, you need to see how you're motoring along, and you need to evaluate how things are going. And of course, things will not always go according to plan, so there's modifications that need to be made. You modify, you have a new plan, and you re-implement it, and you continue with the process. Now, having formulated your goals and selected the right strategy, the selection of the tactics are vital. The most important part of business management is the goal setting, and the number one goal for your business and most businesses is to make a profit. If you don't make a profit, you go out the back door. You no longer have a business. And the essential element in making a profit and having a business is managing, or how you manage the money. And an ongoing major goal then is to how to improve your bottom line continually. Instead of being satisfied for a constant set profit and never growing, if you really want to succeed in business, you should be on an annual basis increasing results. You should have growth in your business, and you should set that growth at a certain percentage. It could be a 3% growth, 5% growth, and for some businesses it could be doubling your business every 5 years. Whatever it is though, you need to quantify what your goal is, what that target is, because if you don't quantify what your target is, then how do you know when you actually are successful? When are your strategies working? It's only when you measure by looking at the numbers that you can see whether or not you're achieving that goal. We can promise you, Six Figure Consulting, a specific quantifiable goal. We'll guarantee to increase your retained earnings by 33%. It could be more, but that is at least the minimum that we'll guarantee, and it's not a bad goal, not a bad objective for you to have when you start out with us. Now, how will you know when that goal is achieved? It's pretty simple, isn't it? You'll see the money in your till. Now, most business decision makers fail because they don't specify the goals. They hit the target that they're aiming at and they haven't specified a target. They don't have a game plan. There's no business plan by which they operate. Some of them say they've got it in their head, but who can see what's in someone's head and whether or not it's tangible? And the next reason why business decision makers fail is they do not apply the one basic economic concept which is essential in order to be profitable long term, and that is the concept of capital efficiency. Most business owners and investors have never heard of this, and accountants are also generally ignorant unless they've studied economics. Now, within the realm of capital efficiency, it needs to be looked at dollar by dollar, and that is the marginal efficiency of capital. If you look at every area of your business, you can apply this one concept to in order to optimize profit significantly. The marginal efficiency of capital involves looking at every last dollar of capital that you put into the business and every dollar that your business generates by operating the business. The same applies when you're actually making investments. Not talking about business, but just say putting money into the stock market. You want to have a look at what you're getting for your dollar. If you're buying a business, what are you getting for every dollar that you put in there? And when you're running a business, what are you getting for every dollar that you spend on every part in your business? If you have a look at all the different areas of your business where you spend money and you maximize the efficiency of the capital in each of those areas, then the combined impact is going to be an overall magnification of your profitability. The same applies, without saying any more, on investment returns. All the various areas of your business add together, and the way to significantly improve your performance is to combine them rather than look at them individually as one-offs. We're pleased that you're here to have the opportunity to view the video. Please watch it to the end to discover what you can be doing in your business to maximize profit performance and end up with more money in your hand immediately. There are two business centres. There's a profit centre where the money is made, and there's a cost centre where the money is spent. And accountants love this because they can balance these two centres. What we want to do is have them out of balance. We want the profit centre to be much larger than the cost centre, which then means that we're making money. Now, how you make the money starts with having customers. No customers, no business. The next is getting sales from those customers, not just one-off orders and not small orders. Getting bigger orders and having customers make repeat orders more often, more regularly, will increase overall revenue and profits. And then, of course, ploughing the money that you're making back into the business to generate new customers. A lot of money, therefore, has to be spent in marketing if you want to obtain customers. There's not much point sitting at home tinkering with the machine if you're actually not out there promoting what you've got to sell. You will at times need increased capital for business expansion and development. You could do this by raising capital, you could do it by borrowing, or you can be offering equity participation, or just simply reinvesting into the business. The key point here, though, is with an increase in capital, you can scale your business up, and continually reinvesting what you're making allows you to scale your business further, making bigger, better profits sooner, faster. Now, marketing involves four principal aspects. There's a lot more, but I'll just go through the main ones. First, there's the product. You need to develop design and tinker with the product so it is actually what the market wants. The old English approach to marketing was that they develop the product first, then they go out and look for customers to buy. The American method of marketing was the reverse. They go out and look for customers first. What do the consumers want? And then designing a product to cater for that. If you always supply what consumers want, then you'll always have a market, whereas if you focus on developing your product first, you may never have a buyer. The next thing is, once you've got your product and you know the market, is to look at pricing. how you determine pricing is a vital aspect as to how much money you're going to end up making, and containing costs is another area. Promotion of your product is how the world knows about what you're doing. If you again hide it in the jungle and don't tell anyone about it, it's the better mousetrap theory. Professor Kotler led me to this, and the better mousetrap theory was basically an inventor comes up with this magic mousetrap that's going to trap more mice faster than anything on earth no one's ever heard of. But if you're there, leave that mousetrap in the middle of the jungle, the world is not going to beat a path to your door to buy it. You actually have to go out of the jungle, you have to go down to Main Street, and you have to show your product and promote it to people who will then see it, like it, try it, and buy it. You need a place of distribution. You need to work out your channels of distribution. I wrote a thesis on that years back. There are various marketing channels which moves a product from producer to end consumer. There are a host of intermediaries such as wholesalers and retailers. There's also variations where you can cut out those middlemen and putting in a team of networkers, commonly referred to as multi-level marketers, and they use word of mouth rather than a lot of advertising, and that means the services of the wholesaler and the retailer done away with. The savings in costs then goes to pay the throng, that group of multimedia marketers and networkers. Now, pricing is determined by two principal factors. It's the intersection of two markets. There's a demand market where people who will be consumers of the product determine how much product they will purchase at specific prices. The lower the price, the more they will buy, and the higher the price, the less they will buy. And that's where the concept of a demand curve or demand schedule comes in. The other market is the supply side. The supply side is where the producer of the product has a number of costs, so he can't sell the product below a certain price, otherwise he just wouldn't produce the product. But how much product he produces and takes to market depends on what price he can get for his product. If he can get a very good price, then he can actually scale up. He could put in additional staff, additional machines, produce more, and offer a lot more. However, if the price that the market is willing to pay for his product is low, then the amount of product that he will offer will be low accordingly. So working out the balance between the demand and supply is how the ultimate price for your product will be determined. That'll determine how much will be purchased in the market because of the price that is selected. Now, demand has many factors. When you're starting out doing your market research, you need to have a look at who your customers could be. This might be looking at socio-demographics, you look at incomes, you look at geography, you look at the industries that they're in and their attitudes to your product and just general products. You also need to have a look at how the economy is going, because when the economy is going well, then there are more people with money in their hand, but when the economy is not going too well, the consumers will retreat. You'll also need to look at seasons, because when it's windy and wintry, people will tend to stay indoors, and if you've got snow and floods, similarly. So you can't expect large demand from consumers who have to leave home to buy it. With the internet, the seasonal factor is less significant, except if you're selling radiators, you're not going to have many sales in summer. The economy is a vital factor in determining demand, so when the economy is going really well, then demand goes up, and the demand curve moves out, and people will buy more at any particular price. But when the economy is not going well, then consumer demand contracts, and at any particular price, the amount that consumers want will actually be less. A lot of small businesses don't understand the impact the economy has on demand, although they do see that they're not getting the customers coming through the door. Now, when you're looking at the demand for your product, there's the wants which the consumers express, but that's not what they really want. That's only what they tell you they want. It's what they need that's important. So you need to separate out, is it a want? And the want is not necessarily something which they have a very high need for, they just express a desire, but a need is sort of like food, clothing and shelter, which people must have. And there's a separate training webinar that will come later. That's all that we're going to deal with today in dealing with the marketing side and the demand side. We're going to focus on the supply side, and particularly with the elements of costs. As fixed costs such as your premises, your rent, you've either bought and you have a mortgage, or you use the imputed costs if you manage to pay cash for your property. So whether you're paying a mortgage or have paid cash or renting, you have the costs of your property, and that's not going to vary whether you sell more or less of the product. It's basically known and certain, it's fixed. You need to cover your fixed costs or you're not in business. You then have variable costs, and your variable costs increase as you sell more product. In order to sell more product, you probably need to have more advertising. You need to have more sales personnel, and you need to have more order clerks who are actually receiving the cash, shipping the products, and these costs will change with the amount of product that you sell. There's also semi-variable costs. You will have the back room administration and accounting. Accountants generally don't charge you more when you're selling more, although it would be a good move by accountants to price their services according to the fortunes of your business. However, most of them charge on an hourly basis, and therefore it doesn't matter whether your product is being sold or not, they're still going to bill you. However, it does get to the stage where you may wish to scale up your plant. When your orders increase to a certain level, you've been operating with one plant, say, one machine, but once you reach capacity, you'll need to bring in a new machine. Now, you can't write off the costs of the new machine against the first new item, extra item that you sell. It will be absorbed over time as your orders increase, in which case amortizing your machine against your costs introduces a concept of semi-variable costs. The bottom line, though, is always worked out by adding together all of your costs of fixed and variable, and in terms of pricing and determining the amount you'll supply to market, it's determined by two concepts. One is the average cost. How much is it costing you per item? Because you then have a look against your sales price, what you're selling each item for, to work out your profit. But the most significant item is your marginal costs. That when your marginal costs increase, it gets to the stage where it's uneconomic to supply more to the market unless there is an increase in price. Now, we'll focus on costs, and we'll have a look at how you manage the costs. First, there's the design of your product. there's costs in there without any return. There's research and development. Again, there's an outlay, but there is no sale of product until you actually get to go to market and you're operating. Once you're operating, then you try to recover all of those establishment costs as well as your ongoing continuing costs. You've got the marketing expenses, which you certainly must cover, and if you don't spend $1 on marketing, it's unlikely you're actually going to make a sale. The most significant cost areas in most businesses, let's start with the most significant cost area and then we'll go through a list of them. But the single largest cost that most businesses have is in fact tax. If you have a look at what it amounts to in the US, for a corporation, it's 35%. It actually gets worse because you've got state taxes and you've got other imposts that actually go on there, such as Medicare and workers' compensation. There's little effort though that most businesses put into tackling their tax. They hand it over to someone else, generally their accountant or their bookkeeper, and again they've got to play by the rules. So the little black book, I was nearly going to say the red book, but that's Chairman Mao. The little black book basically sets down how much tax you have to pay based on the amount of income that you're earning. Now, the business owner sees these numbers and not being terribly happy with it, at the end of year he asks his accountant to do something. This accountant has already totaled the figures. There's not much for the accountant to do. He might fumble around and find a few extra deductions, but there's not much. It's a matter of reading off from the table how much tax is payable, and that then determines what the business owner must pay to the IRS. Now the business owner grumbles, he's disgruntled, he tells the accountant to have another go at it, and the accountant has another go, fumbles around, comes up with a few more deductions, and then the bottom line is still not much better. There's a small reduction in tax at BEX. It's far too late at the end of the year, once you've earned the money, to start doing some tax management. You need to start at the beginning of the year and you work out a game plan at that point in time. Now, your game plan, according to most corporations, is you're paying that 35% tax rate. You also pay state taxes. In some states you're fortunate where there's zero tax on income, but in other states it's sort of, and some over 9%. The average is around 5%. So when you add the state taxes to the federal tax, you come in with a gross tax figure of 40 cents on the dollar. That means out of every $100 of profit, you actually end up in your hand with only $60. Now, is that your game plan? Because if you have not set down in your business plan how are you going to deal with your tax, this is your game plan. 40 cents in the dollar is what you've determined at the start of the game, before the whistle blows each year, that you intend to pay 40 cents in the dollar on every dollar that your business makes. Are you happy with 60% of what you make? Now the other imposts, as I briefly mentioned, I won't go on any further, but there's your payroll tax, your Medicare levy, your workers' compensation, and a pile of other things which when they total up can be quite significant, at around 25 to 30%. Now this is our game plan. We use the principle of capital efficiency. So we want to reduce costs. We're not happy with where costs are, or you shouldn't be happy where costs are, and if you can improve your costs, that should increase your profits. It's like pushing in the balloon at one end, comes out the other end. Now, you should be targeting by how much you're going to reduce costs. It's not a matter of not having a goal, not have a quantified specific target. So let's say you want to reduce costs by half. Now this may not be achievable, so you've got to make your goals realistic and achievable. So in terms of things like cost of production, you're certainly not going to be able to halve the cost of all your product. Same goes with your marketing and your advertising. But one area that you can concentrate on and set a quantifiable goal of reducing it by half is in the area of tax. So instead of flushing your $40 down the drain, how would you like to just flush $20 down the drain and save 50% of your profits that you're currently losing? So is that a reasonable target, a reasonable goal for you to set? It does not necessarily mean you will achieve it. It's a target. You then have to have your strategy and your tactics to make that goal become a reality. And that's what we can do for you. That's our game plan, to save you half of your tax. Now let's have a look at your after-tax profit. Your bottom line is your retained earnings, right? Of the $100 or 100,000 or 100 million, however much you make, just call it 100. How much are you keeping? Is it whittled down to 60? Who set that target for your business? How about you set a different target? We have a revised target for your business. How does this sound? Retained earnings, 80% of profits. Is that a better target? That increases to 60 by 20. That's a 33% improvement in your after-tax profit. Now, it's not going to cost you anything to do it. The reason being, you use your tax to pay for all costs, and your 33% improvement is after costs and after tax. Now, the tax tactics can be first to reduce your tax. The next is to defer tax. I'll mention more about that in a moment. Then, when you have deferred tax, just invest the tax dollars that you got hanging around until you have to use them to pay the tax. If you make provision for your tax during the year, which you should, then it shouldn't just be sitting there in the till. It should be invested, at least in the money market, to get your return. And if you're able to defer tax longer, then you can invest for a longer term and get a better result. But the objective to do the most damage is to eliminate tax as much as you can. It doesn't mean you'll be able to eliminate every dollar in tax, but it's not a bad target to look at ways that you may be able to do that and do a lot better. And this involves structuring your business. Firstly, if you're a small business, you shouldn't be operating as a sole proprietor. That's just sort of tax ridiculous. You should have at least a LLC, and what we recommend, Six Figure Consulting recommends, is actually a C Corp. There's a lot of particular advantages there, which, strangely enough, a lot of accountants seem to be unaware of. But people on Wall Street, in investment banking, certainly know what corporate finance is about. And this is how people like Mark Zuckerberg got $16 billion tax-free, simply by issuing shares in Facebook. Now, you can't do that in your LLC, but you can do it in a C Corp. And it doesn't mean you have to have an entity like Facebook of that scale and magnitude, but you certainly can still use the same concepts of corporate finance. Now, when you can claim a deduction, claim a deduction. Have a look at every dollar that you're spending and where it's going and how it's going, and have a look at what you've classified, or your accountants classified, as capital expenditures where you're not getting a tax deduction, and see whether you can get a tax deduction for it. One of the simplest way of getting a tax deduction on your real estate is not to have real estate in your business. If you hold your real estate outside of the business, which you should be doing as an asset protection strategy, then you can be paying your real estate entity rent and claiming real estate within the business as a tax deduction rather than as a non-deductible capital expenditure. So have a look at what you're doing with the real estate in your business, if you've got any. If you do have real estate assets in your business, you should be removing it quite rapidly, quickly, because you're just asking for a problem if in fact you ever have someone trying to sue you for something that's occurred in your business. It could be a supplier who you haven't paid. It could be a consumer, someone who bought the product and there was something wrong with it, or it could be simply a disgruntled employee. If you have property in your company, in your business, then it's at risk. Move it outside of the business and claim a deduction for it. Now, the various areas of business that you can be looking at doing better with are things such as rent, wages, stocking, that is the buying of your product and how much you're putting on the shelves and how often you're stocking and for how long you hold inventory, what's your turnover period of the stock and what it's costing you for that, and how you're doing your financing. Just quickly on the financing side, it's a trick that banks quite often use when they offer businesses finance. They offer overdraft facilities. Do you know anyone who's got an overdraft? Do you have an overdraft? Have a look at the interest rate that banks charge for an overdraft facility. It's not your low interest home loan rates. It's somewhere in the order of 12%, and at times it can actually escalate and be much higher. But what does the bank do to secure the overdraft facility that they provide your business? In most instances, the bank require that you provide some collateral, and this would often be taking a second mortgage on your home, on real estate, but instead of giving you a home loan interest of 6% or 4%, they are charging you the 12% or 15%. So an immediate improvement can be obtained on the financing of your business by simply going to the bank and demanding to alter and restructure the overdraft facility and your home loan, and simply go for a line of credit, using still your home as the collateral, but having a home loan rate of interest and not that of a bank overdraft. Okay, advertising is another cost of business. Spending $1 to make $1, they say. Well, no, that's sort of the accountant balancing the books again. You should be spending $1 to make $2. If your advertising is not bringing in at least 100% profit, that is, for every $1 spent, you're getting $2. You need to look at changing advertising, getting a new advertising agency, because you should be doing a lot better. Now, equipment hire is another thing where people basically throw money away. Firstly, they may buy equipment. Remember, I just went through not holding property in your business because there's no asset protection. You have that same problem if you buy equipment and have it owned by the business. Any equipment that you end up or do buy should be held in another entity outside of the business, and you lease the equipment from that entity. Now, a good tax tactic is to have your equipment owned by a Nevada corporation or a Delaware corporation or a Wyoming corporation. Any idea why? Because there is no state tax in those particular states. So a Nevada corporation can own the equipment, and your business will actually pay the Nevada corporation, and there will be no state tax on the income. Yes, you'll still pay federal tax, but if you're set up and operating in a high income tax state, this is one way you can reduce your taxes, at least on the state level. Now, consulting fees are another area of business, and you need to have a look at who you're paying for what. Most people pay an accountant, and they pay an accountant too much. The reason they pay an accountant too much, the accountant bills them an hourly rate, and the bill actually may not be a lot of money, but what it actually is costing you for your accountant is what your accountant is not doing. It's what your accountant is not producing. If your accountant is not reducing your tax, if he is not saving you at least 50% of your tax, that is what your accountant is costing you, and that is why he is, in most instances, costing you too much. Now, we have a different approach to how we operate. We don't charge you fees, so there's no risk involved of hiring us to help you achieve your goals and objectives, whether they be tax management, whether they be salary packaging, or general marketing, or just business advice overall. We work on a results-only basis. No results, you don't pay us a cent. We believe in a profit share arrangement. If what we do is we're going to save you half of your tax, we're going to put our hand, our arm, down the tax drain, and we're going to pull out dollars and give it to you. How do you feel about us pulling out more money, if we can, and keeping that surplus? Giving you the 50%, which is our guarantee, and whatever else we're able to manage to scrape out, we keep. That's the basis of our consulting fees. It does not cost you a dime. If you want to get serious, then start saving money, and then you can start making more money, because with the money that you can save, you can put it to work in your business or in external investments. Tax management has two elements. Firstly, there's the tax incidence. This is where tax actually raises its ugly head. When does tax occur? It occurs when you receive income, right? So if you receive income and you don't have expenses sufficient to absorb that, then tax is payable. The next area in tax management is the tax burden. The tax burden is actually the payment. Who actually pays that tax? Now, there is a process where you can manage your tax burden simply by shifting it to someone else. Instead of you paying it, someone else pays it. If in fact you have more tax to pay on what you're doing, you might increase your price. When you increase your prices, who then pays? Well, you still pay, but not all of it, because your consumers will also pay a bit as well. However, that might not be a good move in the long run, because if your prices go up and demand goes down, then you can end up losing revenue and being worse off. So you may not be able to shift the tax burden in that particular instance. But there are other ways you can shift the tax burden. You can actually prepay. Now, if you prepay, you're going to pay someone that you would normally pay, and they're not paying any more tax than what they would normally pay, but it's a matter of timing. So if you were to prepay, say, advertising for the next year's campaign, if you were to pay in advance the hire of your vehicles and your machinery, you're still paying those people. They're still going to pay tax on the money you give them, but you've been able to shift the tax burden from you this year to them, and if they've received it in advance, a smart accountant working for them will be able to adjust the books so that they won't have to pay tax until next year, even though they've received the money. In the end, though, what matters is how much tax are you actually paying. You may be able to shift the tax burden, you may be able to defer it, but ultimately it's going to catch up. One of the best ways to manage tax is just not to receive income. You can take out loans. One person who's a wizard at this is Donald Trump, the President of America. He has massive loans for billions of dollars from Deutsche Bank, and this is one way that he's able to actually have money without paying tax on it. The loans initially, going back a few years, Donald Trump had a number of bankruptcies, and there was only one bank, Deutsche Bank, that was prepared to lend him any money, and all that he could offer as collateral was his name, right? So he basically signed, and loans were advanced by Deutsche Bank on the strength of the Trump name and brand. But over time, as Trump invested in real estate and developed properties, he was able to increase his borrowings and also to shift the liability from his name, his person, to the corporations that actually held the real estate. So the real estate took over the loans, and Donald Trump didn't have to pay any tax. There's a lot of issues with Donald Trump and his tax, so I won't go delve into things further, but he's a wizard at actually borrowing money. Now, raising capital, that's certainly another way to get tax-free money, as I mentioned already with Mark Zuckerberg. You can issue shares in your company, in your business, and basically people give you money. It's all tax-free. You give them a piece of paper says they have one share, and how much was the share worth that you sold to them? Might be a dollar, might be $100, could be $1,000. You can determine the price, and they will accept what the amount is by agreement, so that you can raise any amount of money that people are prepared to give to you and not pay a cent in tax legally. The next thing, when you borrow money, you have a loan initially, and you've got an interest expense on that loan, and even if the loan was interest free, the IRS comes along and says, we impute that there's an interest on that of 4% and we'll charge you tax on it. So the way to overcome that tax burden, or the incidence of tax, is to actually convert the debt into equity. So instead of you owing people money, the company actually issues shares. These shares can be of various classes, giving in some instances, in a lot of instances in fact, no voting rights and no entitlements. All they've done is they've taken the share, the equity in your company, in exchange for removing the debt. I mentioned briefly before prepaying. If you took something like advertising and prepaid this year, then all of the money that you prepaid comes down as an expense in this year's books, and that's going to reduce your income quite significantly. It defers tax. In fact, it pushes your income into the following year. Now, the master of tax deferral is George Soros. He's also a forex, foreign exchange wizard. He made billions on shorting the pound sterling years back, and he's a hedge fund manager, if you're not aware of who he is, right? Now, he is the master of tax deferral. He basically squirrels away all of the tax dollars that he should or could be paying, because he has some very smart accountants and smart lawyers, right? Now, George is not against paying tax. He basically believes that people should pay tax. He's made public statements to this effect. But he also believes that you should choose when and where and how you pay the tax. So his strategy, which works quite effectively, is defer tax as long as you can and invest that money, and he's made billions over the years with the investment of the taxman's money. He's basically got an interest-free loan from the IRS, and he's had this for years and years and years, right? Now, he owes reportedly in the order of $6.7 billion, and he started with 12 million, right? Now, how do you turn $12 million into 6.7 billion of tax that you owe? Well, he's actually made a capital sum in the order of 15.9 billion with that $12 million that he started out with. So why invest your tax with deferral? Well, George is a good example of this. All the accountants had worked out that if he'd paid tax at the time his income was earned, then the $12 million that he had as investment capital would have grown to only 2.4 billion. It's estimated that George is currently worth 28.8 billion. So you can have a look at the difference there. If you've got a calculator or your brain is up to it, deduct the 2.4 billion from the 28.8 billion, and you can see what the benefit of the tax deferral was. Well over 26 billion. Now, managing the tax burden starts with claiming a tax deduction for anything and everything that you can, by deferring it and by having a look at all the areas of your business and prepaying as much as you can at the end of the year if in fact you're going to get hit by a truck. And that means prepaying rent for the next year. It's a legitimate expense if you're going to stay in your premises, so why not bring forward the payment of rent? Now this can have an advantage for a landlord. Landlord might say, oh, don't pay me the rent, I've got to pay tax on it. Well, the smart accountants, as I mentioned, should actually have booked that as belonging to next year for their own returns, tax returns. But having that money early, what can the landlord do? The landlord can invest that money. Just putting it into the money market for 12 months is going to get a return. Having it early, he might be able to use it as a deposit on another property, using leverage, gear up, and make a 5-time return over the next 5 years. So all sorts of things having money in advance can do for your landlord, and it shouldn't be terribly difficult to convince the landlord to accept a rental prepayment. Just put money in his hand and see what he does. The same thing can happen with your advertising agencies. When do you pay for your advertising? Very rarely have I, in fact not rarely, I've never seen an advertising agency that accepts payment in arrears. That is, you only pay after the advertising's run. They all insist in you paying up front. Now, when you hire an advertising agency, they have to go and book the media. They need to book television. They do the design, prepare the ads, but then they have to book the media, and then they have to make payments. Some of it is actually paid in advance, and some of it is paid sort of ongoing as it occurs. What you do though, when your advertising guru comes along to you and comes up with a great new campaign, you basically say to him, okay, well, can I pay you later? And he said, no, you pay me up front. All right, you pay him up front for the advertising. You want to repeat that campaign for the following year. When should you make the next payment for the next year's advertising? Do not wait until next year to do that advertising payment. Make that payment before the end of this year, and that has given you double the tax deduction in the current year. It sort of catches up with you because every year, if you've prepaid, you've then got to prepay for the following year, otherwise you fall behind. The same thing can occur though with your equipment hire, and you can do the same thing even with your consultant. You have a consultant working for you doing something, well, you just offer them to prepay their fees for next year. And this is something, again, we'd be happy to accept also. We have a way that we manage our own tax, and we're quite happy to accept fees in advance and prepayments each year, because we're not going to have any problem managing our tax, and it's going to do you a favour by letting you put money in our hand, isn't it? Sorry to laugh at it, but it's a matter of most people just do not know how to manage their money, and there's some very simple things that you can do, some very simple strategies if you start thinking about how you're operating your business and you start managing your business to make an operating profit. And it should begin with tackling that largest, biggest cost that your business has, which is your tax bill. If you lower your tax bill, which could be by deferral, or it could be from just general reduction and elimination of some of your tax. Deferral is not the only answer, but as I said, in terms of George, what were his advantages? Now let's have a look at the available of having more capital. If you save your tax, or if you make more sales, you use that money in your business. Anytime your till fills up with money, you're going to go down to the bank. What are you then going to do with that money? You're going to let it just sit in your bank account, earning little or no interest? Are you getting any interest on the money there in your check account? Now, use that money, put it to work. You could put it outside externally into an outside investment, but if you use it in your business and you do it, sort of strategically, you should be able to get 100% profit on that. And if you did that continually, then you can compound that money, and who cares in the long run then if you've got to pay tax on more money. Investing it externally, there's some attractions there. The investment returns are not that great compared to your business, but it does provide you with a way to get money out of your business and to give you some asset protection. And if your business is in a risk sector, or you just wish to diversify so that you lower your exposure to economic risk or industry risk, it is a sensible thing to do. Use it as an insurance policy and borrow back money to keep your business running. So it's not that you necessarily lose access to the capital when you invest it externally, as long as you set things up in such a way is that you can borrow against that external investment, put it back into your business and claim a tax deduction for basically borrowing back your own money. This is a device, in fact, that Google uses to bring money onshore. It's got billions of dollars offshore, so what it does is it borrows money in America and claims the interest as a tax deduction, and using the capital that it has stashed offshore as collateral, as security. So use the taxman's money to make money. Until the whistle sounds, you finally have to pay your tax at the end of the game, right? But paying the taxman with his own money, how does that sound? Right? Now, you also have the opportunity to arbitrage. Now, arbitrage is basically working on a guaranteed profit. It's something which traders use where they can buy at a certain price and they can sell at a certain price. Both prices are known, and they can work out whether there's a profit to be made or not. And when there's a profit to be made by being able to buy at a lower price and sell at a higher price, should you do it or not? Well, the same thing works in your business. When you buy stock at say 40 and you sell it at 60, you make a 50% profit. You buy it at 50 and you sell it at 100, you make 100% profit. There's arbitrage there. It may not be guaranteed unless you know that you'll be selling the products for sure, but businesses are in fact based on the concept of arbitrage. Unless you can use payment in arrears, right? Or on consignment, in which case you sell it before you have to buy it. Now there's tax arbitrage. How many people know what that is? Tax arbitrage is a matter of just using the differential in the tax rates. There's a tax rate for income tax, which depends again on what level of income you're at as to what the rate is. But if we just take the corporation rate of 35%, or take the total rate, the average when we've added on state tax of 40 cents on the dollar, that's your income tax rate. Now there's gains tax rate. The gains tax rate is a concessional rate. It's quite lower. It's less than half, in fact, of what the income tax rate is, being only 15 cents in the dollar when you sell a capital item for a profit. The requirements here, though, are that you must wait 12 months, hold an asset for at least a year, in order to get this concessional gains tax rate. Now, it cannot apply, the gains tax rate won't apply for your corporation. You know, they've got all sorts of strange rules, and it's a matter of knowing how you do all of this stuff, right? But if you have an LLC and the LLC has members who are individuals, then the profits actually flow through to the individuals. Now this is a method whereby you can take income from a corporation, pay it into an LLC and stream it through to individuals who will pay tax at the individual rates. They may be able to pay tax at lower income tax rates depending on how they've managed their tax and who they distribute the income to, or they may be able to structure the income into gains tax by pushing the income into expenses that they might have for property investments and other investments that they may have. If you have a choice though between paying a 40 cents on the dollar tax rate, how do you feel about paying a gains tax rate? Now, making provision at 15 cents on the dollar is not something which most corporations can do, but we're able to do that. We're able to help you with the arbitrage. We manage our tax at we have a provision of 15 cents in the dollar for our tax, and you could arbitrage against that your 40% tax rate. We don't do it for free, there's a nominal cost. So you can see we make a profit of about 5% on the exercise, but in terms of our profit percentage, if you have a look at the fact we pay 15 cents on the dollar, but we're going to make 5 cents on each of that, then our return is the 5 cents on the 15. So we're actually making quite a good percentage return on that. We've got an ROI there of around about 33%. But in terms of your own situation, you can drop your tax rate or your cost of tax down to just 20 cents on the dollar. So you've made a 50% profit in that instance, just looking at the 40, but when you add it to your bottom line and do the numbers, adding your 20, I know it's getting a bit convoluted here, adding the 20 that you end up saving to the 60 that you otherwise would have had, is actually giving you an improved return of 33% in your retained earnings. Now, you should know what retained earnings are. That's what you got left in the till after you've taken out the money to pay the tax man. If what you've got left in your till is $80 instead of $60, the 20% increase is a 33% improvement in your after-tax profit. Now, what should you be doing with every dollar? Make every dollar count. Make your retained earnings improve. And what are you going to do with that dollar? You're going to invest it. Where are you going to invest it? The best place, in most instances, should be back in your business. Although external investments can be entertained in certain circumstances. But you need to be aware that when you make an external investment, it's not tax deductible. The returns that you're going to make are going to be nowhere near as attractive as what you can make by reinvesting into your business. The investment externally is of a capital nature. There's no deduction unless you might be borrowing funds to invest and you pay interest to borrow those funds. Whether you're buying shares in the stock market or whether you're buying real estate, the deductions are largely for interest when you're borrowing to do it, or in the case of real estate, there's some depreciation allowances. Putting money back into your business is going to grow your business. It's going to lead to giving you more sales, more customers, and more profit. What can your business produce having extra dollars of capital in it rather than putting it externally? What's the comparison as to what it can yield? Every dollar back in your business can be used to cover expenses. Those expenses after tax are only going to cost you 60 cents on the dollar, whereas if you're investing externally into capital, it's costing you 100 cents in the dollar. Business expenses cover, or should cover, deductible items. You should not be actually buying capital equipment. As I pointed out earlier, use a Nevada corporation. Do not buy capital, but buy, or let's say hire items, spend money on advertising to promote sales, to get more customers, hire more staff, give staff a better reward, buy more stock, you got more things to sell, you got a better variety, a better display, so then your customers will buy more. The cost of buying stock is coming down to only 60% of what you actually spend because of the tax breaks that you're going to get. Later, not in this seminar, you can find out how you can use your business revenue to effectively structure your property investments. It takes particular engineering to do this, and it's going to be a while before you'll qualify for that information. So you'll get a little later on. At the present time though, just focus on reinvesting into your own business. Doing that will improve your retained earnings, as I've illustrated. I'll go through it again. The extra 20 that you've got, you spend. Now that 20, when you spend it, should make money. So let's say that 20 can be turned into 40. That is, you can make 100% profit by reinvesting that 20. That 20 that you're then making as higher profit, it might have been you spent the money in advertising, right? Or you could spend it across the board in all areas of your business. But if you look at turning that 20 into 100% return, your 20 turns into 40. Then you got to pay tax on that 20 of extra revenue, extra profit that you receive. So are you going to make provision for tax on that at 40 cents on the dollar? If you make provision for tax at 40, then you're going to lose 8 and you're going to end up with 12 after tax. Still, that's an improvement in your retained earnings. If you go back to the initial sort of scenario where you had 60 after tax and we showed you how to get an improvement of 20, so you got 80 after tax as your retained earnings, we're now adding on another 12 to that 80, So that's going to give you 92 after tax. But you can do better. There is, in fact, a smarter way to manage the tax on your extra 20 of earnings, and that's the tax arbitrage, which I've already given you an explanation of, right? It's possible to hold on to 16 instead of 12. What would you rather have? An extra $12 in your till or an extra $16 in your till? If you add that 16 onto the 80, then your retained earnings goes up by 36%, $36, not just $20. You've then got in your till your original 160 plus 36, there's now 196. So instead of being left with what you're currently doing, having 160 after you've made 100 profit, you got 196. What would you prefer to have? Now the big question is, what are you going to do with all the money? You've now got 196 sitting there in the till. You had originally the 100 of capital that you put in day one. You made your profit, which we increased from 60 to 80 to 96. So you've got 196 there. What are you going to do with it? You can spend it, you can save it, but you shouldn't save it. What's it going to earn when you save it? It's going to earn 0 or pathetically 1% if you're lucky in the bank, right? You should spend it, but only on your business operations. You can make more profit and then magnify your profitability over and over again. Every time you reinvest it, you will increase your profits exponentially on a compound basis, and you're going to get a return far greater than the 33% that you were promised in the beginning of this webinar. We give you that as a profitability guarantee because that's certainly achievable. In terms of how much you actually make, how much you magnify your profitability by, it's up to you how regularly you reinvest your profits and how much profit you're able to make on each item. You might find, in fact, in your marketing strategies, you adjust your prices. So it may be attractive to your customer to have an offer that if they buy an extra 10 items after their first 10, you will drop the price. Now you can afford to drop the price because you've got tax savings. So the discount on price is funded out of your tax savings, but the amount by which you give them a discount is not going to absorb all the extra profit you make. The result's going to be, though, in this example, you'd sell 10 more items. You could have a sale for new customers as well, as discounts for 1 day, 5 days, or on special day. Again, attracting more customers. One bank that I remember used to do this quite regularly was Citibank. Citibank, in fact, would drop its interest rates when everyone was charging much higher rate. And what do you think that did for its business? It gave them a flock of new customers. But they did the dirty on those customers because you know what they did later on? They increased their rates and the rates went back to what all the competitors were charging anyway, and in some instances even higher. But they'd captured all those extra customers by providing a discount, and in the scheme of things it didn't actually cost them a cent to do it. We give you a profitability guarantee to improve your current position by at least 33%. It's up to you to decide whether you want to take that for zero cost or just keep donating to the tax office 40% of what you're making. Now, here's another area of your business that you should focus on, or you should be looking at, And it's an area that most owners and the managers of the businesses pay no attention to. By failing to address this, it is costing you 30% more on all your wages and salaries that you're paying to your employees. You could actually do better with the money by adjusting the budget each year. You could pay your employees more and you could actually save money. This is the area known as on-costs. Your on-costs cover a multitude of sins. The biggest ones are in fact payroll tax. Every time you sort of have a whole heap of wages to pay, you've got to pay payroll tax on that. You've also got workers' compensation based on what your payrolls are, and in industries like construction it can be exceedingly high, right? But most of the on-costs do come from your wage bill. It's just a necessary part of your staffing costs. But again, you do not have to do nothing. You're at liberty to do salary packaging. Salary packaging is done most often for executive, for high income earners, for highly paid professionals such as engineers, right, and computer specialists, and anyone that's on a high wage, right. The high costs of on-costs hit in and erode the profit of your business. They amount, as a minimum, on sort of low-end staff, such as clerks, only 25%. But on the high end, in terms of construction-type industries, workers' compensation costs are massively high, and the average figure then for on-costs are around 30%. Now let's have a look at your wages bill and how you're paying your personnel. Are you paying them wages? You're paying them salaries? You're paying them consulting fees? Are you giving them a share of profits? Are you giving them things like car allowances? Have you got retirement plans, 401ks and things? It's all staffing costs, but how you structure it can save you money and ultimately give your employees a much better deal. Ask your accountant to do what they can, and after he's had a try, then give us a call and we'll show you how we can improve whatever your accountant's been able to come up with. Do all your sums on the average of 30% in the dollar, 30% of wages as your on costs, rather than the possibly slightly lower 25%. It just makes it easier to do the calculations, and it makes sure that you don't skip out on something. Now, I'll give you an example. It's a real life example, not a made up example, of the impact of costs. Here's the case where a number of years ago, I think it was about 2001, I was having lunch with a couple of software engineers from Computer Associates. At the time, CA was underwater by $500 million. Talking to these two guys, I was able to see why, and I could also see how things could be improved substantially. This might also apply for your own business. So you just pay attention to the example, and although the numbers are going to be different, have a look at the concepts and you see whether or not this could work in your business. Follow it up later with a free consultation with us so we can see whether they're and it depends how significant wages are in your business. In some businesses, wages
are a significant component. In other businesses, wages might only be a small component. Here are the rough numbers though that the two guys from CA showed me. On the wages, before tax, each of them were earning $350,000 a year. That's not a bad earn, is it? Now after tax it got whittled away, right? Their take-home pay was a lot less,
and it was around 220 grand a year only, right? Again, nothing to be sneezed at, but have a look at what they were giving up. 130 grand a year was just being drained off down the tax rat hole. You know? Now, let's have a look at the on costs for the company. The on costs for CA were around 30% in the dollar, right? So of that $350,000 wage, add on another 30% to see what the total staffing budget was for CA per employee. Now, you have a calculator? All right, this is the sum which you got to do in your head, right? Or borrow your accountants, right? Now, these guys told me, this was, a surprise to me, there were 2,000 others working for CA doing the same thing that they were doing on the same wage. Can you multiply those numbers now by 2,000? Have a look at the total wage, right? This before the on costs, right? There's $700,000 just being paid to the employees. But what were they taking home? They're only taking 440 million. I think I said dollars rather than million, sorry. They were taking home $440 million, but were being paid $700 million. You can see how much the tax office was getting? $340 million, $260 million, right? It's the difference of the 440 million and the 700 million. It's just gone down the tax drain. No one in the company getting any benefit. CA didn't get a benefit from it, and the employees didn't get a benefit from it. Now, in addition, CA had an expense of another 30% for on-costs. The expense for on-costs was not on the take-home pay, but it was on the 700 million. So that was something like $210 million were being paid in on-costs. So you can see what's wasting away. 260 million went to the IRS, and another 210 million goes to on-costs. Together, can you add those two numbers up? It's almost $500 million, isn't it? A little bit shy. The total outlay for the company, for CA, was $910 million a year to pay employees $440 million. There's a loss of close to $500 million, which could have been stemmed merely by managing the money that was draining out. It doesn't happen if you do nothing. If you do nothing, then you basically follow the book of rules, and it says you got to pay, and pay. $500,000 is what they had to pay, simply because they didn't bother to address the simple areas of on costs, which is based on wages and salaries, and salary packaging, which can be adjusted to reduce the impact of tax. So when you see $500,000 flowing out of CA that year, no wonder they had a loss. Now, if your business is of the scale of CA, you certainly need to do something pronto and learn how to structure your salary packages. Structuring your salary packages, you can end up paying your employees more, and you can be saving money too. You can certainly be saving money on costs and minimising on costs. Every dollar that you can reduce in salary, you get a 30-cent saving in your on costs. So, how much would you like to save in on costs? Now, trap the tax dollars of those salary incomes. The CA employee is a very good example. They were taking home 440 million, and they were giving up 260 million. Well, you could do a profit share arrangement on the 260 million. Maybe you give the employees an extra 100 million. How would they feel about that? and what you end up with is an extra 160 million. Now, I got some bad news for you. You're not going to be able to do all this stuff by yourself. As I said, you could get your smart accountant to have a look at it and do what he can. But after he's had a go at it, call us in. If he stuffs something up, we're going to undo it, and we're going to take a percentage of what's being saved and given to the employees, and of what's being saved and given to yourself. How much are we going to charge? We're going to charge you nothing. It will cost you zero, because we only get paid on a results-only basis. You can apply this principle of marginal efficiency of capital throughout your business. We've only today just looked at these two areas, right? We can run through the whole lot in every area of your business. You don't have to be a biggie, you don't have to be a CA to call us in. We'll work for any company, any business that is earning at least six-figure profit, right? So if you're making 100 grand, you're going to be paying 40 grand in tax. You can call us in, we can help you. If you're not yet a six-figure earner, then your business is too small for us to really have a look at. But this strategy can still be applied to your business no matter what the scale is. Do you care to discuss this in terms of your business, how the strategy might be applied? The capital efficiency of money is how to improve your bottom line. Don't use it, you'll lose it. We give you the guarantee of improving your bottom line by 33%. We can greatly magnify your overall profitability, though, by helping you reinvest that immediate return, and that will compound exponentially to a much bigger profit and guaranteed larger and larger result. Apply MEC to every component of your business and be a winner. Don't apply it and miss out on significant improvements that you could have to your overall management performance and certainly your bottom line. Now, we provide a free online consultation to six-figure earners, seven-figure earners, or businesses that have projected earnings in that magnitude. You're invited then to apply for an appointment. Let's set a date within the next few days. The cost is zero. You've got nothing to lose other than your tax. If you want a free appointment to see how the strategies of MEC can be applied to your business, just click the link underneath here. Now, if you're not in the six-figure bracket, maybe you would like to increase your income, your earnings, and you might even consider possibly working with us as a six-figure business consultant. Start out making six figures, and then the sky's the limit. Become a seven-figure earner. Just make contact with us and we can see whether or not you're suitable. We're happy to discuss the prospect of you working with us if you have the desire and the intellect to deal with the concepts that we'll show you how to use. Six-figure consulting is the way to improve your profits, but don't be disappointed by delaying. You need to hurry to make sure you get in before the rest of the crowd. But first decide whether you want to be our client, our business partner, or both. Now apply now just by clicking underneath. This is step 2. It's no obligation, it's free, and it's up to you. Apply now for a free consultation with six-figure consulting. We are a financial management and marketing consulting firm We have specialists in a number of other areas. So if you have need in areas other than just financial management or marketing, please contact us and let us know what your requirements are. We'll be pleased to help. Looking forward to hearing from you shortly. Goodbye for now. You might connect with us on LinkedIn. This is the link, the address.